Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. Over the past week, we've had more details in regards to the exchange FTX, FTX US, and Alameda, and what may have potentially led to their $10 billion downfall. I won't speculate on it here as the details continue to emerge, but it's certainly safe to say that FTX is more likely than not no more going forward as an exchange, even though you still have Sam SBF attempting to raise capital, which really makes you question where his head's at right now as far as understanding the full gravity of the situation. But this will likely take many years to unravel, let alone decide which jurisdiction this will even fall under. For those unaware, in 2013, we had Mt. Gox, a Bitcoin exchange that was hacked several times, only found out later after the fact, running a fractional reserve, and in fact exploded. This was offshore, this was in Japan, and they still have not returned Bitcoin to the creditors that was recovered. And we know that because we can look at the wallet addresses. I know this hasn't been updated in several months, but I can assure you these haven't moved. You can look at these wallet addresses as you can with any blockchain that's public and see if there is any assets held within that address. You can track that. You can get alerts for that. You can get real-time updates should anything change or move. And that's what we're seeing currently with anything FTX related, anything Alameda related. The sleuths are out in full force, hunting everything down, hunting down all the connections, as I'm sure several chain analysis companies like Chainalysis are drafting a blog post on it as we speak, and or working with law enforcement, figuring out what's going on there. So there will be more to come in the following days, but as we are in the industry and those of us who remain here now have to deal with the sentiment shift, the regulatory punishments likely coming, the changes in regulation, certainly welcomed. One of the frequent points raised as to why FTX got as big as it did was because certain activities were unregulated on US shores, and that only pushed people elsewhere. Here's a list of the centralized exchange landscape according to DeFi Llama, and several exchanges have come out since FTX imploded saying this is what our reserves are, these are our wallet addresses, this is what transparency and accountability looks like on our end. Some of these exchanges in the US are publicly traded, obviously, and they have different reporting requirements. Nevertheless, it would behoove us as the industry to have a collective understanding of expectations here going forward, considering what happened with FTX and Alameda. And I'll leave all these blog posts in the comments below, but again, we can see all of these addresses. In this case, not perfect because this is a snapshot. Some of these are cold wallets, meaning wallets that aren't actively used. Some of them are hot wallets, meaning wallets that are actively added to and withdrawn from. But all those distinctions can easily be made once this data is all aggregated. Some exchanges don't reveal their cold wallets, but they do have other reporting requirements, obviously based on being in the US and being regulated. Coinbase here highlighting transparency and risk management, Kraken doing the same, as well as Gemini doing the same. And they're doing what needs to be done and saying, we aren't like this, this is who we are. The problem is now, again, as an industry, we have to put our best foot forward here in establishing what best practices should be and need to be, as well as participate in the formation of whatever regulations are coming down the pipe, which assuredly are coming based on what happened with FTX. As we talk about contagion risk and understand who was using FTX as an exchange, who held their token treasuries on FTX, who had venture investments with FTX. This is a list from Woo Blockchain, but again, some of this is fact, some of this is speculation. It's all evolving, but the contagion is vast and many. More to be revealed, certainly in weeks and months ahead. BlockFi today being one of the bigger companies announcing a potential bankruptcy following FTX Contagion. So it took around 200 days to hear about FTX in regards to Luna and Terra blowing up. This is all semi-related or heavily related, depending on who you ask and how you want to measure this, to the deleveraging event that occurred with Anchor, Terra, and UST. So it's fair to say you'd expect any further deleveraging to happen over the next couple months. One way we can look at what is sentiment right now on chain. What does sentiment look like based on market cap, based on stablecoin activity, based on coin movements? Are people selling? We could see that. Are people sending coins to exchanges to panic and throw their hands up in the air and say, you know what, I'm done, I'm out of here. This is speculation, right? That's one read I'll show in a second. But there's ways to measure that and look at that. The first being stablecoin dominance, which to me is a semi-measure of risk on, risk off. And if stablecoin dominance is rising, that typically means we're in risk off conditions. Now, we haven't had stable stablecoin market cap since January 2021. We have had stablecoins rising in general. But if we compare to January 2020, there was only one stablecoin, that was Tether, that was in the group of having a market cap greater than 1 billion. Now there are 4 stablecoins that have a market cap greater than 1 billion. So there are ways to stay within the crypto ecosystem that does not involve selling to cash or exiting or using an off-ramp. And again, we can measure all that because all this data is available. So stablecoin dominance is still extremely high on a relative basis, as you'd expect if this is a risk-off environment, which I think it's safe to say that it is. If we break that down further, looking at stablecoin circulating supplies, we can see that once again, when there is risk of contagion, people get nervous about Tether. That's what this suggests based on Tether's circulating supply in the orange here, which again saw redemption requests to I'd say a significant degree. Unlike FTX, if you have the reserves and it's backed and held one-to-one, or the reserves are liquid, or the reserves are what they should be, then handling these redemption requests has no friction and is a non-issue. And thus far, that has been the case with Tether. Also, much like Luna, Terra, and that fear of contagion, we're seeing a spike in USDC issuance, almost to an equal degree that we see USDT redemptions. And the only reason I'm really paying attention to all this stuff is because it's a great way, I think, to measure sentiment. You're also seeing Binance USD continue to increase in circulating supply, and the purple here being the DeFi DAI, essentially flat. So you are seeing a flight to safety, a flight to perceived safety out of Tether. And another way we can look at that is the Tether price. This is on Kraken specifically. This is USDT against USD. And when people talk about Tether losing the peg or Tether being unbacked, they kind of point to this without really knowing that people can, on the open market, accumulate Tether at any level they wish and redeem it to Tether the company, should Tether be solvent, which so far they were. I'm not a Tether defender or anything here, but one thing you could do as a market participant is arb out this difference and say, okay, I can buy it for 94 cents, 96, 97, 98, and then I can go to Tether and redeem it, right? Now, these are people who at the time may have believed or been concerned with risks of Tether being insolvent or Tether's relation to FTX and Alameda, right? Who knows what goes through people's minds, but they're clearly losing a significant portion on this trade. It's by selling below $1. Even today, as we sit, Tether's slightly below $1. And just to compare and contrast that to USDC on Kraken, again, USDC, USD. USDC will have spikes up and down, but for the most part, has a tighter range around $1. So there may be different market makers for either of these stablecoins on exchanges, but in any case, it appears as though they are both on the up and up with their reserves. As far as Bitcoin sentiment on chain goes, we can look at a few different things. One being, when was the last time as a group that coins aged 1 year or more have moved? We can also look at non-zero addresses or addresses with a non-zero balance to see, is there accumulation there, or are users, individuals cashing out, right? That's another way to measure that. So if we look at coin age, coins continue to age into that 1 year plus bucket, meaning we're seeing fewer and fewer people, if these are all individuals, which they aren't. Again, there's caveats here. It's not exactly one-to-one with one address equals one person, but as a group, we're not seeing a massive redemption of Bitcoin for cash or exiting the ecosystem. We're not seeing a massive cashing out, as it were, against non-zero balances. Those continue to increase sort of irregardless of price, irregardless of what's happening here with FTX. Some of this is exchange balances and wallets. Some of this is vanilla, Joe Public just being involved. We can also look at on-chain activity, which has increased during these events, throughout these events. This is the monthly average of active addresses. So those are addresses that have changed in value over the previous day, and transaction counts, both of which have been increasing on the Bitcoin side of things. And then balances on exchanges, as you might expect, continue to decline. This is centralized exchanges. If faith in centralized exchanges declines, you'd expect to see a decline in Bitcoin held on those exchanges. And if we look at which exchanges, in this case, Glassnode measures, you can see the list here as far as centralized exchanges. So I have to assume this data is clean, this data is real, because it's much different than 2018 when we saw mass deposits to exchanges as we broke down a price range. Lack of exchange reserves help when we're talking about float or expectations of additional downside or selling pressure. We're not seeing that. Again, if we measure it in a bunch of different ways, we're not really seeing that. Where we are seeing selling come from are miners. So this is miner net position change, and green is accumulation. Red indicates a reduction in their net position. And we're seeing miners here based on known miner wallets by Glassnode, which is about 90 to 95% of all mining on Bitcoin is known and labeled. So this gives you a very good idea of what's going on the miner side of things. And we are seeing additional miner selling at these levels. Ultimately, nothing out of the ordinary that we haven't seen. In 2017, in the run-up, we saw tons of miner selling into that strength. In 2018, we saw tons of miner selling sort of after price declined significantly. This was another mining whale sort of selling into strength here in January 2021. So it doesn't look as though we're seeing sort of mass capitulation from miners, but we are seeing selling pressure, certainly. Moving on to some ETH on-chain and exchange data. Again, I look at this and I think to myself, I think this is real. I trust Glassnode. I trust their data. If we look at the exchanges listed here, it makes sense to me. But we're seeing a mass decline in ETH on exchanges. Now, where could this ETH sit? It could sit in DeFi. It could sit in personal wallets. MetaMask, for example, is a very popular personal wallet. But there are a multitude of places this ETH could be, not on centralized exchanges. Just to compare and contrast, again, in 2017, we saw ICO craze. We saw ETH get pulled off to participate in ICOs. That was pretty clear. ICOs peaked in 2018, and ICO treasuries then mass deposited ETH to exchanges. Price fell. So much like Bitcoin, this helps the argument that maybe we won't see that movement for significant downside because that supply side pressure isn't sitting on exchanges at the moment for ETH either. It's almost to lows rarely seen based on measurable data, since 2017. So it'll be very interesting to see if we continue to get this rapid movement out of exchanges, or if this data is mislabeled, which I doubt, but it's always a possibility. So I have to take the bearishness of the event of an exchange blowing up with the on-chain data and saying maybe this won't have as great of an impact as sentiment would lead you to believe. ETH 2.0, this represents ETH sitting in a staking protocol. You cannot remove this ETH. So again, another supply soak mechanism at nearly 15 million ETH. That continues to increase. And ETH transaction and on-chain activity sort of curling down, but still higher than we've seen outside of any period other than the previous all-time high. So there's still a ton of activity happening on the DeFi side of things. It is waning, but it is still significant historically. If we look at ETH's issuance since the merge, since they switched from proof of work to proof of stake, ETH has actually gone deflationary here. You can see the supply change is down to a negative 6,000 ETH over the past 61 days. So that, again, certainly helps gauge likelihood of massive price declines on a relative basis. And if we look at the ETH comparison between proof of work, proof of stake, and BTC, again, we can see that the difference is rather stark when we're talking about issuance today versus what it may have been with proof of work. Moving on to some technical stuff, I'm going to start with the DXY, which continues to come to its natural end in that, as expected, based on technicals alone, we are seeing that triple top, that inverted Adam and Eve, however you want to think of this as from a technical perspective, meeting its measured move, 1618 fib extension. Even if you don't know patterns, if you don't care, one easy way as a value add for yourself to pick up this knowledge is to just take the range and measure it to the upside or to the downside, dependent on the expected move or the bias. And that gives you a general relative idea of what to expect. So we're currently in the wheelhouse for what to expect for DXY. This yellow line here is the mega multi-year previous range ceiling. So it'll be more interesting once we get back in that range, if that is the case. But this is very good for crypto should this continue to decline. Looking at BTC, previously I talked a lot about this volatility squeeze, and it is always interesting how we, coincidental or not, get these volatility squeezes sort of waiting for something to happen. Something maybe unexpected happens, in this case, an exchange blowing up, and then we get a resolution of that volatility squeeze. We currently are trying to push lower on the Bollinger Bands, which does indicate an expectation or a bearish bias. Measuring that against the previous two bear markets and looking for levels, if we're talking about 80 to 85% from the previous all-time high, that's somewhere between 10 and 13. The question, again, comparing this to the on-chain data, is who is here to sell or buy at this point? And how are we going to get there, right? If these coins on FTX are locked potentially for 10 years, that may be an overestimation, but if the coins are not liquidated quickly across the board, we certainly have Contagion to deal with. We have redemptions of products to deal with. We have sentiment shift, obviously. But is that enough to keep us pushing lower? I don't know. We will see. Purely based on TA, there is an expectation that at this point, there's at least an attempt to go lower. And zooming way out, we're about halfway through previous periods where we make a full recovery to new all-time high. May 2024 being the next halving date. And you can see how prices sort of react into and post Bitcoin halving. When people talk about 4-year cycles, historically this has been what's happened. Certainly no guarantee into the future. Looking at more of a near-term stance, again, if we measure that range from range high to range low, in this case specifically post breakdown, again, we get that 10 to 13 level as a possibility. But there are certainly no expectations in my mind that this has any near-term bullish surprise. We're still below trend metrics. We're hovering back into this trend channel once again. So I think it's fair to say bias here is bearish based on several metrics. On the ETH side of things, we're a little more neutral, still leaning bearish in that we are below key moving averages, below the 200-day, below the 200-week, near previous all-time high from 2018. Still fighting to get out of this trend channel. Sub 1,000 ETH, it certainly isn't an expectation, but it's on the table if we continue to drift lower. ETH against BTC continues to look very good, meaning that there's an expectation for ETH to outperform BTC even in bearish conditions. This is a complete 180 from the previous charts based on technicals in that we are above trend metrics. So we have a bullish expectation here. There's all sorts of potentials for chart patterns, whether it be an inverted head and shoulders or ascending triangle. But ultimately, so long as we remain above this weekly cloud, there continues to be, no matter how messy and sloppy sentiment is and everything else, there continues to be a technical expectation for bullish continuation here. And measuring the emissions or supply difference between BTC and ETH, there's a story and a narrative potentially building for that to occur. Certainly no guarantee, obviously, but it would make sense if that were to happen. Now, some coins like Matic continue to do well. Matic continues to develop real-world use cases and partnerships, mainly NFT marketplaces or NFT integrations. some Web3 stuff. Recently, they announced partnership with Nike, but they've been in partnerships with Disney, Facebook, Reddit. I mean, the list goes on and on and on. It's kind of amazing what their business development team has done in the past year. But I think that's why you're seeing prices where they're at, even with this volatility, this event with FTX. You're still on the bullish side of things when it comes to trend metrics based on technicals. And then lastly, I just want to talk about Link, because Link was another one leading into this FTX debacle that was setting up for a series of higher lows, multi-month, right? This is not a one and done situation. Multi-month higher lows, currently sitting near a range low, flirting with flipping trend metrics bullish after many, many months since all-time high. So the next thing to watch on Link would be, can this regain the range high? Can this regain trend metrics? And essentially, can it reconsolidate at the range high? That's what you're looking for. On technicals for Link, Link has some staking, some fundamental events coming down the pipe. From a technical perspective, this mimics Y coffee and accumulation. And this is another sort of fractal we see typically at bottom of markets where levels sort of stabilize and you get this repeated pattern. So potentially for Link, even if you don't trade it, it's just interesting to look at and watch. We're currently, in this spring phase potentially for Link. And the next steps would be, like I said, returning to that range high. That's all for this one. This week, this video is for informational purposes only, and the opinions expressed are not financial or investment advice. All opinions are my own and do not reflect the opinions of Valkyrie Investments and its affiliates. No fiduciary obligation or duty exists or is created between you and Valkyrie Investments or its affiliates, including me, by virtue of any opinions expressed in this video.